Warren Buffett is one of the very few investors who are widely recognized by the public. He achieved this fame by starting to invest in the 1950s and turning his early successes into a massive portfolio worth billions of dollars. Buffett is among the richest people in the world, and that's because people frequently seek his advice. In this video, I'll lay down Warren Buffett's 7 key secrets for building a durable and successful stock portfolio of your own. If you want to learn how to get rich, you might not expect a lesson on building good habits. But that's exactly what the first secret to investing like Warren Buffett is all about. To invest, you need money, so before we even talk about choosing the right stocks, we need to discuss how to save the money you're going to use. But where do you start? First one is to set aside 10% of your earnings. Put this money in a separate savings account or a place where you can't easily spend it. Avoid the temptation to use this money. Once you have the savings account, keep adding to it with every paycheck. Starting small and gradually increasing your commitment is a proven way to form a positive habit. It's all about making things manageable and consistent. Many people set overly ambitious goals at the beginning, only to stumble and abandon their good intentions, which can be discouraging. But how much do you aim to save? A good guideline is to create a solid emergency fund that can cover your expenses for some time if your income is disrupted. Wealthy people save money, set it aside and watch it grow. There's a reason for lottery winners who suddenly become millionaires often waste their fortune, because they haven't developed the habits to keep them wealthy. Imagine you stumble into a bizarre universe where you can buy $1 for only a quarter. How many dollars would you want to buy in this situation? The obvious answer is as many as possible, right? While we won't be crossing into alternate universes anytime soon, making a really smart investment is somewhat similar. This brings us to the second secret, known as value investing. Some investors simply guess, but others like Warren Buffett follow a method. They take clear steps to figure out two things: the true value of a company and whether the stock price matches that value. That's the essence of value investing. By studying the market, examining the right data and reports, you can discover undervalued stocks. In simple terms, it means finding businesses whose real value is higher than their stock price. Of course, there are no guarantees in the stock market, but investing in undervalued companies is a solid strategy. It's certainly more reliable than speculating or going with your instinct. It's possible that an undervalued company could become even more undervalued after you invest, potentially costing you money. This is where another of Buffett's strategies comes into play: patience. More often than not, the company's true value will eventually be recognized. Alright, let's say you saved some money for value investing, but there are so many businesses. Where do you even begin your search? Consider what genuinely interests you. It's a great starting point. Warren Buffett is well known for not investing in businesses he's not familiar with. That's why he avoids computer and internet-related companies. He calls this concept the circle of competence, which is the third secret. It's the ideal point where your interests and investments come together. You can find your own circle of competence by asking simple and logical questions about your interests and your understanding of business success. Start by listing the types of businesses you've worked for. Then list the businesses you frequently spend money on. Finally, consider your areas of expertise and your hobbies. By doing this, you can identify industries or business categories that fall within your circle of competence. And that is the answer to the initial question. This list is where you should start looking for companies to invest. Now, let's move on to the fourth secret, which is economic moats. Buffett didn't just adhere to value investing principles by identifying undervalued companies. He also searched for stocks that had a protective barrier against losses, which he referred to as an economic moat. As you'll discover, this is another factor to consider when seeking sound investments. While we can't predict the future with certainty, one thing is clear: there will be numerous fluctuations along the way. Some businesses offer products or services that have the potential to withstand market volatility and changing trends. This resilience is what an economic moat provides. Consider Coca-Cola, for instance. It's a brand that has weathered economic depressions and world wars, appealing to generation after generation. Others like Pampers have become so ingrained in our culture that we often use the brand name instead of the product itself. These are examples of companies with an economic moat. Another aspect to watch for is this: can a product maintain higher prices and still attract customers? Nike and McDonald's can. These are companies that are likely to remain leaders for a long time. Another indicator of an economic moat is having an economy of scale, often linked to an efficient low-cost production model. Companies that have achieved this can offer more affordable prices and outperform competitors. Amazon is a prime example of this. When you shop on Amazon, you often find unbeatable prices. But economic moats may not last indefinitely, especially in the realm of technology. So, it's essential to ask whether a company's product or service relies too heavily on innovation to survive. You might think that the iPhone has a strong economic moat at the moment, but its popularity depends on Apple staying ahead in the tech race. In the not-so-distant future, a more innovative product could potentially render the iPhone obsolete overnight. By this point, you should have a pretty good idea of the types of businesses Warren Buffett seeks when making new investments. Now, let's dive into the more technical side of value investing, the details of figuring out a business's true value. The fifth secret to investing like Warren Buffett is about understanding the language of business. This means learning how to read financial statements. To grasp the basics, let's run through a quick scenario. Imagine you come across a business that initially appears to be a good investment opportunity. Let's call it Kevin's Construction Company. You'll want to review its balance sheet, income statement, and the cash flow statement. But how do you access them? A simple Google search should do the trick. Okay, let's begin with the balance sheet. It reveals a company's actual equity, meaning its net worth. You can calculate it by adding up all the company's assets and subtracting all its liabilities, including debts. Pay attention to the company's debt-to-equity ratio. For instance, if Kevin's Construction Company has $500,000 in debt and $1,300,000 in equity, that results in a 38% debt-to-equity ratio. Surprisingly, that's not a bad result. Many companies have a debt-to-equity ratio of 100% or even worse. Next, focus on the income statement. It displays the company's net profit, which is its income after taxes and expenses. The crucial factor here is the return on equity. Here's how it works. Suppose Kevin's equity in 2015 was $1 million. The income statement reveals that in 2016, it made a net profit of $520,000. This means its return on equity is 52%, which is excellent. In fact, anything above 15% is pretty good. Finally, you'll want to scrutinize the cash flow statement. It provides insight into how the company manages its money. You want to see consistent positive cash flow year after year. While all businesses may experience temporary negative cash flow due to significant purchases or sales cycles, you want to review years of records and find a history of positive cash flow. Analyzing a company's finances might seem tough, but once you know what to look for, it becomes second nature. Even if a company's financials show it's doing well and making a profit, it doesn't tell you when to invest. That's where the sixth secret, valuation, comes in. Simply put, you want to buy stock when it's cheap and about to rise. The net-net method, developed by Buffett's teacher Benjamin Graham, is key. It compares a company's net current asset value and NCAV per share. NCAV is what's left after a company sells everything to pay off debts. For example, let's take Kevin's Construction Company with $700,000 in assets and $650,000 in liabilities. Kevin's NCAV is $50,000, and with 20,000 outstanding shares, NCAV per share is $2.50. Now, check if Kevin's stock is selling for less than $2.50 per share. If it is, it's a good sign, but Benjamin Graham preferred a 33.3% margin of safety. So, go for it if the price per share is 1/3 less than NCAV per share. Let's shift our focus from the complexities of mathematics to the more straightforward aspect of portfolio management, which is secret number 7. Nobody gets it right all the time, so maintaining a diverse portfolio is a wise move. Take Warren Buffett for instance. He's invested in hundreds of private businesses and holds shares in more than 40 publicly traded companies. As Buffett himself puts it, diversification is a shield against not knowing. Now, let's talk about the 5 rules of portfolio management. The first rule is about fund allocation. Before you start investing, decide how much money you want to invest right now and how much you'll set aside for future investments. Moving on to rule 2, it's quite straightforward. Never put more than 10% of your investment into a single stock. In other words, don't put all your eggs in one basket. Rule 3 is all about ranking your prospects. If you're considering 20 companies, take the time to rank them based on your confidence in each. This provides you with a clear strategy that the higher the ranking of a company, the more of your money it deserves. Rule 4 emphasizes the importance of reviewing your portfolio at least once a year. Keep an eye on the annual and quarterly reports that your invested companies release. Finally, Rule 5 advises against selling based solely on the stock's price. A good company is more than its stock value. Consider your investment like an employee. Would you fire someone just because they're having a bad day or a tough week? Outstanding companies can experience significant price drops from time to time. In fact, Buffett loves to invest when a strong company's stock price takes a dip. So there you have it, 7 investment secrets to kickstart your journey in making sensible and well-informed investments. While they might not turn you into a millionaire overnight, they provide a solid foundation. The rest is up to you.